Well, hello everybody. It is the end of May. It's the weekly review. Take a look at what happened, what looks like is next up, how we try to take advantage of it, and the risks that are out there. So let's get started. Last week, down week, nothing huge, but down nevertheless. The strength was in the Nasdaq. That strength is reflected primarily off the semiconductors, somewhat biotech, but it's really merger and acquisition happening in the semis that held this up. Nasdaq, of course, the leader this year, double the closest gains of what happens to be the Russell. Um, Listed issues still struggling, and they're going to continue to struggle. I don't think that's going to change, and we'll talk about that here in a second. Technically, fundamentally, a quick review. Really, China, it finally has entered into what looks to be a range trade. And so if we take a look at that, China had a huge push forward. Matter of fact, if we pull over, say, a monthly chart and look at it, you can see the magnitude of this move. 2,000 to 46, almost 5,000. And that's, that's in less than a year. Just basically a year. So a tremendous gain. And, you have to expect at some point that sort of a gain is going to come to an end. And you're going to get a consolidation, and that consolidation is going to be a big consolidation when it happens. That happened this week. I'm on the daily chart. You see the last 2 days of the week, volume expanding as this comes down. Now, what you want to look at is the first time that you get a pullback, it's not going to kill a move like this, right? When you have a move that's this strong for this long, believe me, the first move down, they're going to buy it. And that's what they did here. And then, of course, got to push up and over. Now, that was a suspect breakout, which is something you have to realize that you can come back on you. What does it do? It comes back to do a retest, regenerate off the prior move. It does a full one, which is also makes sense, right? All of that follows neoclassical thought completely. And it does a hammer, almost a hammer reversal, a doji more like it, off that, which says it's probably going to try to bounce back up and test into it. Now, it left volume at the highs, another good sign, and it came off with volume, which probably says we're in a range trade. Finally, if we look at one more item here, this volume associated with this move is less than the volume of the test, right? And it's less than the volume of the push when it broke out. And so when you combine all of that together, that says that this thing more than likely is going to jam itself right back up into this area. Now it may start out with some sort of a test again, and as long as that test holds, then you have to expect they're going to jam it higher. They probably are going to fail up there, and then you're going to get a bigger pullback. So that's kind of the way this thing is setting up. If I try to look at it just from a pure range perspective, and I take the prior high and project it up, right, and then project that back down, my expectation is when this range actually builds out, it's probably going to come all the way back down here to these lows. And so that's kind of the setup that looks like is starting to take place. That's the sort of setup you want to try to trade if you can. And so we're going to have an order in here tomorrow to try to buy into any kind of retrace into this area with the expectation of flipping it back out on any kind of a decent bounce. Now, if we buy it down here and it keeps going, then we're going to have to be prepared to buy it again at the bottom of the range, the larger range, if it sets up that way. Okay, so that's China. That's the way China looks. The reason I start with China is because if China is going to range trade, again, that's going to be a negative for the rest of the world. Not as big as Europe, because we really are, we're really kind of tied to Europe right now more so than China, because Europe has more of an effect on us than China does. But the fact that they are starting to enter the range trade is, in my opinion, another quote-unquote negative for the world trade range, the world trading equities, in that you don't have this big strong move that continues to captivate the world, and that range trade is going to take a little of the edge off of the upside for the world. Europe also in a range trade. If we go look at them, starting with the CACs, right? The CACs comes back heavy and hard on Friday. The DAX did the same. A lot of fear comes back into the market. That was after they had pushed up to do their retest, regenerate on the higher swing point low. So we already know that this is a range trade. We know that from the fact that these or this particular swing point low was overcome, right? So this is some sort of a sideways range. What typically happens when you start building out ranges is you get a push back, which is what we got, right? So you go up to the tops, you test them, you fail, you come back, you set some sort of a bottom in. That's what's kind of happened here. This bottom does have a little bit more volume on it, so it can certainly get tested again. Then you get some sort of a push back up, which is what has happened. And then eventually that rolls back over, and you're going to test this area again to see if this is the bottom of the range or not. It may not be. It could very well be. You don't know that as the range builds out. What you know is it's going to test it again. If we pull over to weekly, right, we can see that this range that looks so big on the daily really isn't that big when you look at it on the weekly. And there's nothing to stop this from expanding, right, to come back and finally retest, regen off this prior swing point high. Now, I believe, if I remember right, this one actually did already on the very next bar. 45.71. Yes, it did on the very next bar. So you've already had the one retest and then the push, right? It can come back and retest again. So that's a possibility. So if you're buying this range, just like I just talked about with China, you have to be prepared to buy it again on a bigger pullback, on an expansion of that range. My expectation is if that range expands, it's probably going to expand into this high. That's the high here, the breakout bar, right? That looks to me where it would try to expand to. Wouldn't probably come quite as deep, but it could. Again, I don't know that it's going to do that. I do know that if it does it, it offers a much better opportunity, to buy at cheaper prices. So that's what the CACs looks like. If we pop over and look at the DAX, the DAX did the same thing. Big move back, wide price spread bar. Volume not huge, but large. See, volume 1.3. Here you had 1.2, so a little bit less. This could easily come back and test the lower end of this range, and it looks like it looks like it wants to try to do that. But this is so much news driven right now. And I don't know that there. When I look at this picture, right, it tested this low, 11.410, got to 11.403, closes 11.413. So you're just over it. So right now volume less. It looks like it could try to bounce. Looking at it on the weekly, you got the same scenario here. And if we draw in the ranges on this one, and say, okay, take this larger range and then project it down on a doubling, right? That could take you back all the way back in to this type of area. Now, the one thing that I would note here is that, if you draw this with the smaller ranges inside, I think that's a more appropriate expectation. Let me bring that down just a little bit farther. That would be a more appropriate expectation of where this thing could trade next, and that is that you could see an expansion down into this bar, right? And that probably would be the buy area on this one, and you could do the same thing on the CACs. So if this does expand lower, right, the next buy area is probably that high on the way back. And again, it's just a better place to be buying if you're going to buy. So Europe, still in a range trade. They're going to test at some point here fairly soon, probably. They're going to test those lows. If you think about the Greek situation and the news flow, Greek has a big repayment this Friday. That probably won't kill it, but the next two will. That's next Tuesday and Friday the following week, I believe. They need a solution. They need it probably this week. That's going to be the news flow out of Europe. That's what could push these indexes lower. If they do, they're probably going to set up better buys. If I look at the U.S. market, right, the U.S. market continues to hold. I mean, it won't give it up. And a big part of that is not here in the S&P, but it's over in the NASDAQ, and it has to do with merger and acquisitions. If you look at the NASDAQ, whether you're looking at the NDX or you're looking at the NASDAQ as a whole, you still have volume sitting here at the highs. It wants to get tested. 45.62, you got the 45.51. That's still out there. That still wants to get tested. Doesn't mean we have to do it now. We got a doji last week. We went over and under, had more volume on the NDX. If I look at the NASDAQ, kind of the same situation. Let's look at it on the weekly. Here you got the high volume at 51.19. You got the 51.11 within 8 points. This wants to get tested. It's still sitting out there, still wants to get tested, something to be looking at. If we pop over to the S&P 500, the S&P 500 now had a breakdown bar off the highs back in the range. And so we've had a huge range that's been going on for so long. Matter of fact, it'd probably be easier if we looked at this on the weekly. So let's pull the weekly chart up. So that range here, has been in effect for quite some time, this higher range. But before that, you had this range, right? And before that, you had the bigger range. So when we look at this, kind of a nestling of ranges that are shrinking in size, and to some extent, they're about the same, a little bit more time this time than the last, but it got pulled back into the range again. And as it gets pulled back into the range, that prevents it, or I should say extends, the idea that all breakouts keep failing, extensions keep failing, we keep getting pulled back in. Why? Because we have no catalyst domestically to take us higher. Economics don't support it, the earnings don't support it, there's nothing supporting it, and we've got the Fed out there telling us they're still going to try to raise rates. And so this market is really dependent on merger and acquisitions, is dependent on buybacks, and is dependent on the world markets. And that is going to keep us range bound. I don't see how we get out of this until those things change. And so that's what this looks like and continues to look like. And I suspect we'll continue to do that over the next few months. I just don't see it changing. So that's the domestic markets. That's what's happening there. Positives, I'm not going to go to all the charts here, but dollars, bonds, they still look like they're range bound. The markets, as I just said, they're still at the highs. The transports, they confirmed that breakdown last week that we had noted the week before. And if you're a Dow theorist, you look at this and you say to yourself, well, this is a problem. Well, maybe it is, maybe it isn't. The problem to me, with looking at the Dow theory is that, that theory was about, well, some of the components of that theory have changed dramatically over the years. They're not the same anymore. So, if I pull up the Dow transports here, you can see the break last week, broke multiple swing point lows, gets the extension just as it should, and is also doing it here, trying to get back into this high, which is 146.28. If you take classic, the neoclassical theory, when you get a break on multiple time frames, you can expect 2 to 3 bars farther. That's what this thing's trying to do. In other words, you would expect another one this week on this index. So the Dow theory, even though I can't debunk it completely, I can't just go by it blindly because a lot has changed with it, but that is a negative in my opinion. Domestic internals are weak. Now, I've shown this before, I believe. I'm going to show it again. This is a bullish trading signals overlay with the S&P 500. So if you go to the trading signals, here in the tools, every day trading signals are generated. They're bullish, they're bearish. And I was looking at that overlay. I'm looking at just the bullish breakouts and potential breakouts. And so, if you come into here, this is a historical chart going back, almost a year of the data generated from those signals. And what I want to point out to you here is it's a way to measure, to some extent, it's a way to measure in the neoclassical terms some of the breadth indicators that you might look at in a classical method. And so if we go back to last year, during the summer months, there was very little signals and the market was, the internals, let's think about it that way, the internals were negative. You couldn't get hardly any signals that were bullish. And what happens? The market pulls back, off of that as a result of that. If we, here's the S&P numbers over here. These are the bullish, breakouts, potential breakouts over here, the actual and the potentials. When we got to the bottom, right, these signals started to change slightly. And as they did, right, we started to see this expand higher in price. And these things exploded to the upside. That was coming off those October lows. So the bullish breakouts, the actual breakouts and the potential breakouts expanded tremendously. And we got a huge rise in the price of the S&P 500 as a result of that. So, continuing to follow this, you can see that as these start to depreciate, right, you get corrections in the market. As they expand, you get a push back up in the market. Again, here is kind of a low signals. The market's choppy, coming lower. You get an expansion, market expands higher. Where are we now? We're down here in no man's land. Now that's a good thing in that this market hasn't sold off big, but it tells you the internals of this market are not good, yet the price is still up here. It hasn't declined, even though this has. That's a divergence, and it's going to have to resolve one way or the other. And the resolution of it is either going to be that these take off and the market is able to push even higher, or this market's going to have to come down to reflect what's happening with the internals, one or the other. The path of least resistance right now, given everything that I see, looks to be to the downside. I wouldn't be surprised to see this market, right, break this uptrend it's been in, right, and come down to match the negative internals we keep seeing. In other words, there's a dearth of stocks participating in this push higher. And if you have less stocks, showing bullish potential breakouts or breakouts, then this can't continue higher. It has to come down. It's just math. So that's just something, some of the things that I look at internally that I don't share all that often, but that are important to look at, especially at times like now. Fundamentally, it's mergers and acquisitions. I already talked about that. If you just go back and look at last week, Charter and Time Warner, the hookup again. The Broadcom AVGO, right? That merger was the biggest that we've seen in semiconductor space history. And then last week, the mergers and acquisitions that have already been announced for this year are the largest that they've ever been for this time of the year. And you've also got Intel supposedly going to buy out Altera next week, maybe. So that really is what's driving the strength in the NASDAQ, in the NDX, and holding it higher, which is helping to hold everything higher. And again, those price points, those gains in that space, very narrow group, very narrow set of numbers. Folks, this is what's driving this market right now and keeping this market higher. If these dry up and go away, which at some point they will, that market's not going to have that push from what you see there, and it's going to change. Buybacks are also a big part of it. They continue. the Greek drama is going to come to an end. It's either going to be a negative or positive. Depends on, it's a binary event, one way or the other. I don't know which way it's going to go. If you just look at history, they always find a way to solve it, so it probably is going to end up being a positive. And what I mean by solve it is they kick the can. It's almost always the way it works. The negatives to me is the growth just isn't there. I don't think it's going to come. That liftoff that everybody keeps talking about to get 3.5% in the back half of the year, I don't see it happening. I think that's a big negative. Fed still wants to raise rates. That's also a negative, right? I don't know if they'll be able to, but just telling us that they're going to continues to be a negative. What would I watch for next week? I would be looking at the S&P, whether it can get back over those highs along with the NASDAQ testing those highs and whether they fell or not. I think that's where the big story is going to be domestically. Those merger and acquisitions, potentially, if there's a slew of them again tomorrow, then we could see the NASDAQ go up and test those highs. And more than likely, it's going to fail at those highs. I suspect this is going to fail and come lower. News flow is going to make everything extremely choppy. And I'm not talking about just the Greek situation in Europe, but I'm talking about all the data that's coming up here in the economic and earnings. Is really not much in the way of earnings right now, but economics. You've got a huge set of data coming this week. Fed speakers all over the place. OPEC oil meeting, I believe that's Tuesday or Wednesday. Central bank announcements, ECB and Draghi. But you've also got others. You've got the employment numbers on Friday, which are a big number for the Fed. And you got these PMI ISMs that come out at the beginning of the year, beginning of the month, that give you some sense of, they're the most forward-looking numbers that are out there because they're surveys of purchasing managers and so forth. So if you look at the data and just look at how much there is, it's a slew of data. It's going to be very choppy as a result of that. If those points come out mostly negative, mostly positive, or mixed, that's going to just cause a lot of chop in these markets. You also have to realize that we're moving into June, and June typically isn't a good time for the year. June, September are the worst months of the year. Domestically, the issues, they remain the same. I don't see a catalyst to take us much higher. I think we're mired in some sort of a range at best, and we've got a larger risk, right, on the downside. I mean, that risk has been out there and remains on the table. If it happens, I suspect it's going to be a great time to do some buying. And we've been keeping our, powder dry, so to speak, trying to eke out some gains, with little risk on the table. We keep waiting for some sort of a larger move down that we can buy. Will we get it? I don't know. Is it on the table? Still is. And those swing point lows that I've talked about, and let me just bring up the chart again. And we'll use the S&P because it's the easiest one to look at. But if you just go down and you look at these swing point lows, they're everywhere, right? You've got them here, 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 right there, here. I mean, they're all over the place. If this market does start to break down, these become a real problem because they're going to escalate the move down because stops are going to be down there under them, especially down in this area. So, you could move down quite a bit, probably get a bounce off that if you do. But what the point is that there's a lot of damage that could be done if this market starts to move lower, because it's not just there, it's on the longer time frames as well. So in other words, all those swing point lows that we were looking at are right here, but then you start getting into these and these and these down here. So if this market starts to break down, right, we're going to see stops triggered, especially in this area. And then assuming you come down to this area eventually, you're going to see stops triggered if this area breaks. And if you get down to here and it breaks, right, that's even worse because that is on the long-term time frame as well, right? So you got the swing point lows down there. So the potential for something much larger to the downside is possible. It's still on the table. It's not anywhere near actualizing, but we have to realize it's out there. It tells us that we don't want to be too long if this thing starts to move lower. Matter of fact, we want to use any kind of lower prices, and again, going back to the daily, we want to use lower prices that come down into this area because the fear will rise. Use that if you, and it's all about time and price, right? If you get a fast move down, in other words, just a direct shot, the odds of a bounce at that point are pretty high. So the reason you want to buy here is you're going to want to flip some of that and then let the retest take place. If it holds, then maybe that consolidation really was just the big consolidation in this wide range. If it doesn't, then you got a totally different story. And that's when things can really get ugly, right? Because that's when these can break and you can get a much wider range to trade in, which again is probably a great opportunity on a longer term basis. But on a short term basis, if we really trade back to this area, can you imagine a 2100 market at 2000? It really, most people don't expect that kind of a hit. And it's not that big a hit, but we're never taking hits anymore. The only hit we've taken for 3 years is here. It'll freak people out. Going back to the details here. So anyway, that to me is what's on the table this week. I think that these guys are consolidations. We're going to have to see if those consolidations expand in Europe, if they actually take place in Asia. See if Japan actually starts to try to consolidate. Got a lot of data on the table this week. There's a lot happening. Portfolio-wise, we took gains again. Apple, Zeltique. These two are off the board for now. We'll keep watching them. Took money off that EUO. We got like a 4 or 5% gain on it. Finally put in the other side of the spread trade. We'll try to expand that spread trade over time. Added back in Europe as they came back in their ranges. We want to add back in China as it comes back in. Also going to want to add into Hong Kong if it comes in. These two are starting to break out. So the only two that we have left on the table continue to be strong, SBUX and XPI. Now we just have to see, okay, can they hold the breakouts in this market? Nobody can. Or do they fade back in? Well, more than likely they're going to fade in, and we'll just buy them on the fades and continue to have some exposure in our equities. That's kind of a long-winded where we're at. I think it's the same story we've been talking about for 2 months. Don't think it's changed. The only way to trade this thing is to trade the ranges and to keep most of our money somewhere beside here. Because I think the big risk here is that, some exogenous event, whether it's the Fed triggering it, whether it's the Greek exit, whatever it is, some exogenous event holds the potential for a much larger pullback in our markets. If we get that, then it's time to buy our markets. But until we get that, or until we consolidate long enough, they're just not buys here, and we have to try to play ranges where we have strength, we have QE backing us up. That's the idea. Or I should say central banks backing us up, not telling us they're going to raise rates. All right? Thanks a lot. That's where we're at. And, as I said, market internals don't look good. I think we have to be very careful here. Take care.